You are about to hear a full guide to the stock market. This is not a quick tip or a short lesson. This is a complete journey told slowly in a way that you can follow and rest with. By the end, you will understand what a stock is, how the market grows over time, why people fear it, and how ordinary people use it to build safety for the future. Every part of this story is designed to give you both calm and clarity. The reason to stay is simple. Most people feel lost when they hear the words stock market. Some think it is gambling. Some think it is only for the rich. Some feel they waited too long to start. This guide will show you, step by step, that none of those fears have to control you. You will learn the truth about how the market works and how to approach it without panic or pressure. You will hear real lessons from history, where crashes looked terrifying, but recovery always came. You will hear about growth that looked slow at first, but became powerful over time. You will learn how spreading your investments protects you, and how simple habits beat complicated tricks. These are not abstract ideas. They are clear truths that you can hold on to. By the end of this video, you will know why long-term investing has worked for almost a century. You will know how small amounts add up when given time. You will know how to think about risk in a calm way. You will know that you do not need wealth to start, and you do not need to predict the future. You will know what matters and what does not. This story will move in 3 arcs. The first arc will face the fog and confusion that surrounds money and the stock market. The second arc will show the wake-up moments when fear turns into knowledge and shame turns into choice. The third arc will show the redesign where money becomes less of a stress and more of a quiet tool. These arcs are written in chapters, 15 in total, each one long enough to let your mind settle and follow along. You should stay, because the stock market is one of the few proven ways to build wealth over time. Yet most people never understand it, because no one explains it in a calm and human way. This guide is different. It does not rush. It does not overwhelm you with jargon. It speaks slowly and clearly, so that by the end you feel both rested and informed. If you stay until the end, you will carry away a new view of money. You will feel less fear and more patience. You will feel that you have a quiet map that shows you where to walk. You will feel that investing is not a storm you must fight, but a steady season you can live through. You will feel that you are allowed to grow your future without panic. And yet, this is only the opening. Before we step into the lessons of history and the voices of investors, we need to go back further. We need to look at where the fear begins, because the fear often starts not with the market itself, but with the first memory of money. Chapter 1 begins in the fog, where most money stories start. You remember being young and hearing adults talk about bills or paychecks. The words sounded heavy and secret. You did not know what they meant, but you felt the weight in the room. Maybe it was a parent sighing at the kitchen table. Maybe it was a fight about rent. Maybe it was the sound of a card being declined in the store. These small moments shaped the way you felt about money before you ever touched it. The first truth about the stock market is simple. A stock is a piece of a company. When you own one, you own a fraction of that business. If the business grows, your piece grows with it. But this truth often gets hidden under fear. As children, we absorb the idea that money is unstable or out of reach. We hear that investing is risky. We hear that markets crash. We hear that only the rich understand it. These voices build fog. They make the path feel too dangerous to walk. Think about the first time you tried to understand investing. Perhaps you saw charts on the news showing red arrows pointing down. Perhaps you read a headline saying billions were lost in a single day. Those images stick. They do not explain that losses are temporary or that recovery is the normal pattern of history. They only show fear. Without the whole story, the mind fills in the rest. The mind whispers that markets are traps, not tools. Yet, if you look back at history, the picture softens. Over the last century, broad indexes like the S&P 500 have averaged close to 10% growth each year. That growth includes wars, recessions, and crashes. The journey is not straight, but the long path bends upward. Investors who stayed patient saw their money grow. Those who pulled out in panic often missed the rebound. These patterns show that time, not timing, is the most important element. In this chapter, the focus is not on strategies or numbers. The focus is on clearing the fog. You need to know that the fear you feel is normal. Most people grow up with confusing or painful money stories. It is not a flaw in you, it is a shared wound. The stock market feels like a maze because no one explained it in simple words. They spoke in jargon. They wrapped it in mystery. They treated it like a test you had already failed. Here, we slow down. We say it plainly. A stock is ownership. Ownership means you are part of something real. A business sells shoes, medicine, or coffee. You share in its success. That is all. Markets gather thousands of these businesses together. When you invest in many at once through an index fund, you spread your risk. One company may struggle, but another thrives. The group as a whole grows because human effort and innovation move forward. Still, knowing this does not erase the old memory of fear. That is why we start with the emotional side. Think about the first time you earned money yourself. Maybe it was a small job. Maybe it was a summer shift. You held the cash or saw the digits in your account. It felt like proof that you mattered. Then the money went away quickly. Bills, food, or small pleasures drained it. The relief of earning turned into the anxiety of losing. That cycle is what makes people afraid of investing. They worry that money will slip away faster than it arrived. But the market works differently from daily spending. In the market, money does not vanish unless you sell in fear. It moves up and down like the weather. Rain comes and goes, but the season still leads to growth. When you hold, you allow the natural cycle to play out. You give your money the chance to recover and grow. That patience is the hardest lesson and the most healing one. Another reason people stay in the fog is the myth that investing requires wealth. This is not true anymore. Technology allows anyone to buy small shares, even fractions of a stock. You can begin with amounts smaller than what you spend on daily treats. The barrier is not money. The barrier is belief. Once you believe you are allowed to start, the gate opens. Think about what it means for the future. If you put a small amount aside regularly, those pieces grow with time. At first, it looks slow, almost invisible. Then it builds on itself. This is compounding. Compounding means that growth earns more growth. Over decades, the effect becomes large. A few dollars saved and invested early can grow into thousands later. This is not magic. It is math stretched over time. The fog also hides the truth about risk. People think investing means gambling. Gambling is different. Gambling depends on chance. Investing depends on ownership. Businesses are run by people. They produce value, they pay workers, they sell goods, they adapt to change. That is why markets recover from crashes. When economies stumble, people still need food, energy, and homes. Companies meet those needs. Over time, they return to growth. If you stay until the end of this guide, you will see how all these lessons connect. But for now, Chapter 1 is about pausing. Pausing to notice the beliefs you carry. Pausing to see how early memories shaped your fear. Pausing to let in the possibility that markets are not as hostile as you thought. The stock market is not a perfect place. It has risk, but it is not a mystery you cannot understand. As you let this thought settle, picture what it would feel like to replace fear with calm. What if the first thought when you hear the word market was not panic, but patience? What if you knew that storms come and go, but the path continues? That shift in feeling is the first step out of the fog. You do not need to understand everything right now. You need only to know that you are capable of learning, and that learning will bring peace. And this leads us to the next part of the journey. If fear begins in the fog of childhood memory, the storms grow stronger when you face the headlines of adulthood. What happens when the market drops suddenly and the world shouts in panic? How do you stay calm when everyone tells you to run? That is where Chapter 2 will take us. Chapter 2 continues where the fog left us. You now know that fear begins early. The next step is learning how that fear grows when storms appear in the news or in your own account. Everyone has seen a headline warning of a crash. Everyone has felt the chill of hearing that markets are falling fast. The first instinct is panic. Panic tells you to pull your money out before it vanishes. Panic tells you that everything is about to collapse. This is the moment when your emotions can hurt you more than the market itself. Think back to the first time you heard about a crash. Maybe it was the financial crisis years ago. Maybe it was the sudden fall during a pandemic. The stories were loud. They told of billions lost in days. People compared it to disaster. You felt the weight of those words even if you did not own a single share. For those who did, the fear was sharper. They logged in to see their accounts drop in value. Numbers turned red. Charts plunged down. It felt like standing on a cliff edge with the ground breaking under your feet. The truth is that storms are a normal part of the market. They are not pleasant, but they are temporary. History shows that markets have always recovered. The longest crashes took years, but recovery did come. What matters is staying calm long enough for the rebound to arrive. Those who sold in fear often locked in their losses. Those who stayed invested often saw their balances return and grow even more. The lesson is clear, but hard to follow when your heart is racing. This is why perspective matters. If you look at a single day or week, the chart can look violent. It spikes up and down like lightning in the sky. If you stretch that chart across decades, the picture softens. The line slopes upward with bumps along the way. Those bumps are the crashes that once felt endless, yet they became small dents in a much larger climb. This wider view can calm your nerves. It reminds you that storms pass and that the seasons of growth are longer than the storms of decline. For many, the hardest part is accepting that loss is part of the process. Temporary decline is not failure. It is the cost of earning long-term growth. Without risk, there is no reward. Safe places like savings accounts keep your money steady, but they grow little. Markets ask you to accept some movement in exchange for greater growth over time. This is not reckless. It is the trade that history has shown to work for those who are patient. Another reason people panic during storms is the belief that they must predict the future. They think they must know when to sell before a fall or buy before a rise. The truth is that even experts fail to time the market consistently. Studies show that missing just a handful of the best days in the market can cut your returns deeply. No one can know exactly when those days will come. The safer path is to stay invested through both storms and sunshine. That way you are present for the recovery when it begins. Think of how you would treat a friend during a hard time. If you left the moment they struggled, you would miss seeing them heal and thrive again. The same is true with your investments. Abandoning them during a storm means you miss being there for their recovery. Loyalty and patience matter here as much as they do in life. The emotional side of storms is not only about money, it is about identity. When your account balance falls, it feels like a judgment on your choices. You may think you were foolish to invest. You may feel shame. These feelings are heavy. They can make you want to escape, but those feelings are not truth. They are a wave passing through you. If you can breathe and remember the long view, the shame lessens. You see that you are not alone, and that what you are facing is something every investor has faced before. Let us look at an example. In 2008, markets fell by more than 50%. Panic was everywhere. Many pulled out in fear. But those who stayed invested saw the market recover in the years that followed. By 2013, much of the value had returned. By 2020, those who had remained invested were ahead. The same story repeated in 2020 when markets plunged at the start of the pandemic, but then rebounded within months. These are not promises of the future. They are reminders from the past that storms are survivable. You may wonder how to stay calm when fear is loud. One answer is to limit how often you look. Checking your account every day makes the storms feel endless. Looking less often lets the ups and downs even out. Another answer is to automate your investing. When money flows in on a set schedule, you do not need to decide in the heat of the moment. Automation keeps you steady when emotions want to sway you. Building a small emergency fund also helps. If you know you have cash for surprises, you do not feel forced to sell your investments in a downturn. That cushion gives you room to breathe. It keeps you from pulling out at the worst time. It allows your investments to stay put until recovery comes. These simple steps are not tricks. They are ways of protecting your peace during storms. You may still feel fear. That is natural. Fear keeps us safe in dangerous moments. But in markets, fear often leads us to harm ourselves. Learning to notice fear without obeying it is part of the journey. With each storm you live through, your confidence grows. You see with your own eyes that recovery is real. That lived experience is more powerful than any chart. It teaches you to trust the process. As you rest with this thought, remember that storms are not the whole story. They are chapters within a larger book. The book itself is one of steady growth, driven by human creativity and effort. Every new invention, every business built, every worker adding value, all of it fuels the market's rise over time. You are not betting on luck. You are sharing in the progress of people. That progress has setbacks, but it keeps moving forward. This is why patience is the strongest tool you have. Patience is not passive. It is an active choice to hold steady when the world shouts otherwise. It is a quiet strength that protects you from regret. It is what turns storms into stories instead of scars. Each time you choose patience, you rewrite the message you tell yourself about money. You stop hearing only fear and start hearing resilience. Chapter 2 is about seeing storms for what they are. They are loud, temporary, and survivable. They test your nerves, but they do not erase your future. You have learned that markets recover, that panic harms more than it helps, and that patience is the path. You have learned that fear is natural, but not final. This knowledge is the anchor that holds you steady. And yet storms are only one part of the journey. Once you learn to weather them, you face a new challenge. You may grow restless when progress feels slow. You may doubt whether small gains are worth the wait. You may think that growth should be faster. This impatience can be as dangerous as fear. To understand this next lesson, we turn to Chapter 3, where the snowball of compounding begins its quiet roll. You have seen how markets fall and rise again. You have learned that storms are temporary and that patience is stronger than panic. But when the sky clears, another feeling often comes. That feeling is impatience. You look at your account, you see only small gains, and you wonder if it is worth it. You think that growth should be faster. You think your efforts should show bigger results. This restlessness is the next obstacle. Impatience grows from the way we are used to living. We expect quick rewards. We like instant updates and fast progress. When investing, the pace is slower. At first, it almost feels invisible. You put in money, and the change looks tiny. A few dollars of gain, a small percentage. It feels like nothing compared to the energy you put in. This can make you doubt the process. You might even feel tempted to stop. But what looks small at first is the beginning of something larger. Compounding is the name for growth. Building on itself, when your investment earns returns, those returns are added to your original amount. The next time growth comes, it grows on both the original and the earlier returns. Over years, this cycle repeats again and again. What begins as a trickle turns into a flow. What begins as a little stack grows into a mountain. The early years feel slow, but they are the foundation for the later years. Think about saving $100 and investing it. After the first year, if it grows by 10%, you have $110. The next year, if it grows by the same rate, you do not earn 10 but 11, because your returns also earned returns. This is compounding. It looks like a small difference at first, but stretched over decades, it is huge. This is why time is so important in investing. The more time you give, the stronger compounding becomes. Many people feel regret that they did not start earlier. They look back and think they lost their chance. But the truth is that starting now is still powerful. Every year you give to compounding adds strength to your future. Even small amounts started today can grow into meaningful sums tomorrow. What matters is beginning and staying consistent. Regret about the past does not help. Action in the present does. Impatience also comes when we compare ourselves to others. You see someone brag about a big win. You see someone who picked the right stock at the right time. It makes your steady path feel boring. It makes your small gains feel weak. But most of those stories are incomplete. They show the win and hide the losses. They show the highlight and not the pain. History shows that steady, broad investing beats chasing quick wins for most people. Your calm path is safer and more effective in the long run. There is also a mental trick that makes compounding hard to see. Our minds think in straight lines. We expect progress to look even, but compounding is curved. It starts slow and then rises steeply. The steep rise only comes after years of patient growth. If you stop too early, you miss the curve. If you stay, you get to ride it. This is why investors are told that time in the market matters more than timing the market. You need to give compounding enough seasons to show its true power. One way to stay patient is to set automatic contributions. This removes the need to decide each time. It turns investing into a habit. The amounts can be small, but the habit is what builds the future. Over time, those small amounts and their growth combine into something much larger. The less you think about it, the easier it is to let time do the work. This protects you from both impatience and panic. Another way is to set goals that focus on years, not days. Looking at daily changes feeds restlessness. Looking at long-term progress feeds calm. For example, setting a goal to invest every month for 10 years shifts your focus away from short-term results. You measure success by your consistency, not by market noise. This kind of goal builds confidence and patience together. The stories of real investors show how this works. Someone who started in the 1990s with regular contributions saw their account grow through crashes and recoveries. The early years felt small, but by the time decades passed, the balance had multiplied many times. The same pattern appears in every long-term study. The numbers may differ, but the principle is the same. Time and compounding turn steady effort into large results. Think of it in simple terms. Patience in the market is like waiting for a tree to grow. The first seasons show little. The roots are building underground where you cannot see them. Then one year, the trunk thickens, the branches spread, and fruit appears. Compounding is the hidden root work of your money. It is quiet and unseen at first, but it leads to visible growth later. Impatience can also be softened by gratitude. When you focus only on how far you have to go, you miss what you already built. Take time to notice the progress you have made, even if it feels small. Every deposit is a step. Every dollar invested is a seed planted. Gratitude for each step reminds you that growth is happening, even if the curve has not steepened yet. Some people fear they will never catch up. They see large numbers thrown around in the media and feel small. The truth is that your path is your own. You do not need millions to find peace. You need consistency, patience, and a sense of enough. Compounding will take care of the rest. The market does not demand perfection, it rewards time and calm. The lesson of Chapter 3 is clear. Growth feels slow at first. Impatience whispers that you are wasting time. Comparison makes you think you are behind. But compounding is real, and its power builds quietly. Trusting the process, staying invested, and giving it time is the way forward. This is not about chasing quick wins. It is about building a future that rests on steady ground. As you let these thoughts settle, remember that impatience is only one test. Another test comes when you think about risk. You may wonder how much to invest. You may worry about losing it all if one company fails. This fear is natural, and the answer lies in spreading your investments. In Chapter 4, we will see how diversification protects you, and why planting many seeds is safer than planting only one. You now understand that growth feels slow at first, but that patience makes compounding powerful. Still, another question rises. What if all your patience is wasted on the wrong choice? What if you put your money in one company and that company falls apart? This fear is real, and it has happened before. Businesses close, industries change. Even strong companies sometimes lose their way. The thought of losing everything can keep people frozen. This is why spreading your investments is the next lesson. Diversification is the word used for spreading money across many places instead of one. When you diversify, you lower the chance that one failure will ruin everything. Think of it like putting your trust in a group instead of one person. If one member struggles, the others can still carry the weight. Markets are built for this. Index funds and mutual funds let you own small pieces of hundreds of companies at once. When one company has a bad year, another may have a good one. The balance keeps you safer. History shows the danger of putting all your money into one company. There were workers who put all their retirement savings into the stock of their employer. When that company collapsed, their savings went with it. It was not because they did not work hard. It was because they tied everything to one rope that snapped. Diversification cuts many ropes and ties them together. Even if one breaks, the others hold. This truth can ease the fear that keeps you from investing at all. Diversification is not only about companies, it is also about industries and even countries. Some industries grow while others shrink. Some countries face recessions while others expand. When you spread across many, you reduce the risk that one event will destroy your progress. This is why many investors choose broad funds that include technology, healthcare, energy, and more. They also include both US and international companies. The mix is what creates balance. At first, diversification may sound complicated, but in practice, it is simple. One index fund can give you exposure to 500 of the largest US companies. Another fund can give you thousands worldwide. Buying these funds is like buying a basket that already holds variety. You do not need to pick winners. You only need to decide how much you want to place into broad baskets and then let time do the work. This approach does not remove risk fully. The market as a whole still moves up and down. But diversification softens the blow of single failures. It makes the ride smoother. You will still see your account drop in storms, but you will not face the total loss that comes from holding only one company. It is the difference between a rough road and falling off a cliff. Rough roads slow you down. A cliff ends the journey. Diversification also supports patience. When you know your money is spread wide, you feel less pressure to monitor each company. You do not need to follow daily news for every business. You can rest knowing that the strength of the group matters more than the fate of any single part. This peace of mind helps you stay invested, which is the key to letting compounding do its quiet work. There is also an emotional benefit. Diversification reminds you that you are part of something larger. You are not betting on one company's story. You are joining the broad effort of many people and industries across the world. This connection makes investing feel less like a gamble and more like participation in human progress. When you see your investments as shared effort, the fear of losing everything softens. Many new investors hesitate because they want to pick the right stock. They feel pressure to guess the next big winner. The truth is that even experts struggle with this. Diversification removes the need to guess. It says you do not need to know who will win. You can own a little piece of all the players and let time reveal the outcome. Over decades, the winners lift the whole basket. You benefit without the stress of trying to predict. Some people resist diversification because they want bigger gains faster. It is true that holding one winning stock can bring huge returns, but it can also bring huge losses. The risk is not worth it for most people. Diversification offers steadier growth. It may not be as thrilling, but it is more reliable. For building peace and long-term safety, reliability matters more than thrill. Another point is that diversification should match your stage of life. Younger investors often hold more stocks because they have time to recover from downturns. As you get older and closer to needing the money, you might shift some into bonds or cash. Bonds do not grow as much, but they add stability. This balance is another layer of diversification. It shows that spreading is not only across companies, but also across types of investments. Technology makes diversification easier than ever. Apps and brokers allow you to buy low-cost funds that already include thousands of companies. Fees are lower than in the past, which means more of your money stays invested. The barrier to entry is smaller now. You do not need to be wealthy to spread your investments. You need only consistency and patience. When you think about diversification, remember the lesson from Chapter 3. Growth builds slowly. Diversification does not speed it up. What it does is protect the path. It makes sure that one mistake does not erase years of progress. It keeps you on track so compounding can continue. It is the shield that guards your patience. By learning this, you free yourself from the pressure to predict. You accept that you cannot know the future of one company. You do not need to. You know that broad baskets capture the growth of many. You know that time and patience will do their work. This knowledge calms your fear and quiets your restlessness. Chapter 4 shows you that safety does not come from certainty. It comes from spreading your risk. It comes from trusting the broad progress of people rather than the fate of one story. This is how you protect your future and give yourself peace. It is how you make investing less about stress and more about quiet growth. And yet, even with diversification, the journey is not free of challenge. The next challenge comes from emotions. When you compare yourself to others or chase stories of quick wins, envy and shame appear. These feelings can lead to poor choices that undo the safety you built. In Chapter 5, we will look at these emotional traps and learn how to keep calm when the voices of comparison grow loud. You now understand that spreading your investments lowers risk and helps you stay steady. But even with a well-balanced portfolio, there is another force that can shake your confidence. That force comes from emotions. Numbers on a screen are one thing, feelings in your heart are another. Many investors lose not because of poor choices in what they buy, but because of poor choices driven by envy, fear, and shame. Think about the last time you scrolled through social media and saw someone brag about making money fast. Maybe they showed screenshots of huge gains. Maybe they told stories about picking the right stock or cryptocurrency. In that moment, your steady plan felt small. You wondered if you were missing out. You felt the pull to copy them, even if you knew nothing about what they bought. This pull is called fear of missing out. It makes you chase what others show instead of sticking to what you know is safe. The problem with these stories is that they are incomplete. People rarely share their losses. They highlight their wins. You do not see the times they guessed wrong and lost large amounts. You only see the shiny result. Your mind compares your quiet progress to their noisy success. This comparison creates envy. Envy can push you to abandon your calm path and chase quick wins. That is when mistakes happen. Shame also plays a role. When markets fall, you may feel ashamed of your choices. You think you should have known better. You think you are behind compared to others. Shame makes you want to hide from your accounts. It makes you avoid checking balances. It can even make you give up. But shame is not truth. It is a feeling that comes from comparing yourself to a false standard. The reality is that all investors face losses. All investors face storms. There is no perfect path. Another trap is herd behavior. When many people rush to buy something, you feel pressure to join. When many sell and panic, you feel pressure to sell too. This herd effect is strong because humans want to belong. We think the group must know something we do not, but markets often move in waves of emotion, not logic. Joining the herd can lead you to buy high and sell low, the opposite of what builds wealth. The solution is awareness. When you notice envy rising, pause. Ask yourself if the story you saw shows the whole truth. When you notice shame, remind yourself that setbacks are normal. When you feel the herd pulling you, step back and ask if your long-term plan has changed. Most times, the answer is no. The plan still works, it is your emotions that shifted. Naming these feelings helps you return to calm. One practice that helps is writing down your plan before the storm hits. Write down why you invest, what funds you own, and how long you will hold them. Keep that note where you can see it. When fear or envy arrives, read the note. It reminds you of your reason. It grounds you. This small act can keep you from making choices you regret later. Another helpful practice is limiting how often you check your accounts. Looking every day makes emotions stronger. Looking once a month or even once a quarter is often enough. This way you see the bigger picture. Instead of daily noise, the bigger picture shows progress. The daily view shows storms. Protecting your mind means choosing which picture you look at. Remember also that the market is not a test of your intelligence. It is not a measure of your worth. It is a tool. Tools are meant to serve you, not shame you. If you feel shame, pause and breathe. Return to the idea that investing is about patience, not perfection. Every step you take builds your future. That is enough. When you compare yourself to others, remember that every person has a different path. Some have more money to invest, some have less. Some take risks that pay off, others take risks that harm them. Your path does not need to match theirs. It only needs to serve your life and your goals. Progress that looks small compared to someone else can still mean peace and security for you. That is what matters. Emotional traps are powerful, but they lose strength when you see them clearly. Awareness turns fear into information. It turns envy into curiosity. It turns shame into compassion for yourself. Each time you notice and name a feeling, you take back control. You show yourself that you are more than the emotion of the moment. The lesson of Chapter 5 is that the market tests both your patience and your heart. Diversification protects you from financial loss. Awareness protects you from emotional loss. Together, they keep you steady. You cannot stop feelings from rising, but you can choose how you respond. Responding with calm is the difference between staying on the path and stepping off it. As you rest with these thoughts, prepare for the next stage of the journey. You now know how to handle storms, how to stay patient, and how to avoid emotional traps. The next question is how to design a plan that guides you forward. A plan is like a compass. It does not predict the weather, but it shows the direction. In Chapter 6, we will see how to build that compass and how it helps you move with confidence, even when the path feels unclear. You now understand how envy, shame, and comparison can cloud your view. You know how easy it is to lose focus when others shout about wins or when your own account dips in red. What you need next is a compass. A compass does not remove the storms. It does not stop the emotions. But it gives you direction when the path feels uncertain. A plan is your compass. A plan starts with purpose. You ask yourself why you are investing. Some want to retire with peace. Some want to send children to school. Some want to buy a home. Others want the freedom to choose work without fear of bills. Your reason does not need to match anyone else's, but you must know it clearly. Without a reason, every change in the market feels like a threat. With a reason, you can remind yourself why you stay the course. Once you name your reason, you set your time horizon. This is the length of time before you need the money. If you have decades ahead, you can take more risk. If you need the money in a few years, you must be more cautious. Time horizon shapes your plan more than almost any other factor. It tells you how much volatility you can accept. It tells you how much patience you must build. The next step is deciding your allocation. Allocation means how you divide your money among stocks, bonds, and cash. Stocks grow more, but move more. Bonds grow less, but give stability. Cash keeps you safe, but does not grow much at all. A common rule is that younger investors hold more in stocks because they have time to recover from drops. Older investors hold more in bonds and cash because they need safety. Your plan should balance growth and safety in a way that fits your age and your comfort. Your plan also includes how much you will contribute and how often. The amount does not need to be large. What matters most is consistency. A regular habit of adding even a small sum builds strength over time. This is the power of dollar-cost averaging. By investing the same amount at regular times, you buy more shares when prices are low and fewer when prices are high. Over years, this smooths the ride and lowers the stress of timing. Writing down your plan makes it real. Too many people keep it only in their mind. In a storm, the mind forgets. The written plan reminds you. Write down your goal, your horizon, your allocation, and your contribution schedule. Keep it in a place you can return to when fear grows. A written plan is your compass on paper. It points north even when fog surrounds you. Following a plan does not mean never adjusting. Life changes, jobs shift, families grow, health needs arise. Each of these can change your goals. When that happens, you update your plan. The update is not a reaction to market noise. It is a response to your life. This difference matters. Plans should change when your needs change, not when fear shouts. Another part of a strong plan is rebalancing. Over time, markets shift your allocation. Stocks may grow faster than bonds, leaving you with more risk than you wanted. Rebalancing means selling some of what grew and buying some of what lagged. This returns your portfolio to your chosen balance. It may feel strange to sell what is winning and buy what is lagging, but this discipline protects you from drifting too far from your compass. Plans also protect you from herd behavior. When everyone rushes into a hot trend, your plan reminds you whether it fits your goal. If it does not, you pass. When everyone panics and sells, your plan reminds you whether your goal has changed. If it has not, you hold. The plan is not about predicting the future. It is about keeping you steady no matter what others do. Your compass can also include rules for emergencies. For example, you might promise yourself that you will keep 3 to 6 months of expenses in cash. That way you know you will not need to sell investments in a downturn. This safety net keeps your plan intact. It lowers your fear and gives you room to let markets recover. Without this step, emergencies can push you off course. Think about how it feels to hold a compass in your hand. Even if the forest is thick, even if you feel lost, the compass gives you direction. You may not know every twist of the path, but you know which way is forward. That is the peace a plan brings. It does not remove uncertainty. It makes uncertainty manageable. It gives you a steady point to follow. The strength of a plan is not in complexity. Many think they need advanced strategies or perfect predictions. The truth is that simple plans work best. Broad funds, regular contributions, and clear goals are enough. Complexity adds confusion. Simplicity builds confidence. Confidence is what allows you to rest at night. A plan also teaches you patience in a new way. When you know your horizon is decades, a drop this week feels smaller. When you know your allocation balances risk, a headline feels less threatening. When you know your contribution is automated, a storm feels less urgent. Patience grows when you know your steps are already chosen. Another hidden gift of a plan is self-trust. Many people carry doubt. They think they will always make the wrong choice. They fear they cannot handle money. Following a plan proves the opposite. Each time you follow through, you show yourself that you are capable. That trust heals old wounds. It makes you stronger for future challenges. Chapter 6 has shown that a plan is your compass. It gives you direction when storms come. It calms your emotions when envy or shame rise. It reminds you of your purpose and protects you from noise. With it, you can walk forward even when the path is unclear. Without it, you risk wandering in circles. And yet, even with a plan, you may still face doubt. You may wonder if time has passed you by. You may feel regret for starting late. You may compare your young sapling to someone else's oak tree. These feelings can weigh heavy, but they also hold a lesson. In Chapter 7, we will look at time itself. We will see why it is never too late to start and how the years become your greatest ally if you let them. You now have a plan that gives you direction. It points you forward when the noise around you grows loud. But even with a plan, another feeling often creeps in. That feeling is regret. Many people say to themselves, "I should have started earlier." They see others with larger accounts and think time has passed them by. This sense of being late can feel heavy. It can even make you avoid starting at all. The truth is that time is your ally, no matter when you begin. Yes, starting early gives compounding more years to work, but starting late does not mean you are lost. Every year you give to growth is valuable. Even if you begin in your 30s, 40s, or later, you still gain from the steady rise of markets over time. The most harmful choice is not being late. The most harmful choice is never starting. Think of it this way. If someone began in their 20s but quit after 10 years, their growth may stop. If you begin later but stay consistent, you may pass them. Consistency beats timing. Staying invested beats guessing the right moment. History shows this again and again. Long-term investors who remain patient often finish ahead of those who try to time the market perfectly. Another truth is that compounding rewards persistence more than perfection. Missing a few early years is not the end. What matters is the years you commit from today onward. Each year of growth builds on the last. The curve of compounding becomes steeper with time. You do not need to regret yesterday when today is still open to you. Some feel regret because they compare themselves to others. They see someone who started younger or had more resources. They feel behind. But your journey is not theirs. You invest for your goals, not for a race. If your goal is peace and retirement, then steady steps now move you toward it. If your goal is education for a child, then every contribution matters. Comparing timelines only creates pain. Respecting your own path brings calm. The market has shown that patience works across decades. Since the 1940s, every 10-year period in broad indexes has ended positive. Even when starting points looked unlucky, time healed the wounds. This pattern reminds you that even if you feel late, the years ahead still hold growth. You do not need to be perfect in your start. You need to be patient in your continuation. Another reason people feel regret is the stories they hear. They hear about someone who bought one stock years ago and became wealthy. These stories make you think you missed your chance. The truth is that those stories are rare and unpredictable. Most wealth in markets comes from steady, broad investing. You do not need to find the one big winner. You need to join the broad market and give it time. This is why index funds are so useful. They remove the need to pick. They give you exposure to winners as they rise. They protect you from losers as they fall. Over time, the balance tilts upward. Your role is to hold and add. The market does the heavy lifting. This truth makes regret lighter. You do not need to guess. You only need to begin. Another point is that life itself shapes your timeline. Some people cannot start early because of debt, health, or family needs. This does not mean they are failures. It means their path is different. Once stability arrives, investing becomes possible, and when it begins, it still matters. What counts is progress, not perfection. Think of two people. One starts at 20 and invests small amounts but stops after 10 years. Another starts at 40 but invests steadily for 25 years. The second person often ends with more because of consistency. The message is clear. Do not let regret stop you. Let action guide you. When you feel regret, remember that the market does not judge you. It does not care when you begin. It only cares how long you stay. Each year of patience adds to your growth. Each contribution plants another seed. The sooner you start from where you are, the sooner the process works for you. The emotional side of time also matters. Believing you are too late can create despair. Despair makes you freeze, but hope gives energy. When you shift from regret to hope, you unlock patience. You allow yourself to stay invested long enough to see results. You quiet the shame of the past and focus on the promise of the future. Chapter 7 has shown that time is an ally, not an enemy. Regret is a heavy weight, but it is not the truth. The truth is that every year of patience helps. Every step forward matters. Starting today is better than waiting another year. You are not behind. You are exactly where you need to be to begin. And yet, even as you learn this, another question rises. How much risk should you carry? How do you balance the desire for growth with the need for safety? The answer is not found in guessing the future, but in balancing your baskets. In Chapter 8, we will learn how risk and reward walk together and how balance keeps you steady. You now understand that it is never too late to begin. You know that regret only weighs you down and that consistency matters more than perfection. But with time on your side, you face a new question. How much risk should you carry? Growth feels good, but safety also matters. This is where balance enters the story. Without balance, investing feels like walking on a thin rope. With balance, it feels like walking on solid ground. Risk is the chance of losing money in the short term. Reward is the gain you expect over the long term. The two are linked. Higher returns usually come with more risk. Safer investments usually grow more slowly. Finding the right balance depends on your goals, your time horizon, and your comfort level. Too much risk can make you panic and sell when the market drops. Too little risk can keep your money from growing enough to meet your needs. One way to balance risk is through asset allocation. This means dividing your money into different types of investments. Stocks are for growth. Bonds are for stability. Cash is for immediate needs. Each plays a role. Younger investors often lean more toward stocks because they have time to recover from drops. Older investors often hold more bonds and cash to protect what they have already built. There is no single formula. The balance should fit your life and your emotions. Think of your plan as two baskets. One basket holds growth. This basket may swing more, but it builds wealth over decades. The other basket holds safety. This basket does not grow as much, but it steadies your journey. Together, they let you move forward without fear of falling completely. If one basket shakes, the other still holds firm. This is the peace that balance brings. Diversification within each basket also helps. In the growth basket, you may hold a broad index fund that includes hundreds of companies. This spreads your risk across industries and countries. In the safety basket, you may hold bonds with different lengths and issuers. This spreads your risk across time and institutions. Spreading within baskets lowers the chance of one event ruining your plan. Balance also protects you from your own emotions. When the market rises, you may want to chase more growth. When the market falls, you may want to run to safety. A balanced plan keeps you steady. It prevents you from swinging wildly with each change. It reminds you that both growth and safety have a place. It teaches you to respect both patience and caution. Another tool for balance is rebalancing. Over time, markets shift your baskets. If stocks grow fast, your growth basket may become too heavy. Rebalancing means selling some of the gains and moving them into safety. If stocks fall, your growth basket may shrink. Rebalancing means adding more to growth to keep the balance. This discipline stops your plan from drifting too far in one direction. It also helps you buy low and sell high without emotion. Risk tolerance is another key. Risk tolerance is how much movement you can handle without losing sleep. Some people are fine with large swings in their account. Others feel anxious with even small dips. Knowing yourself matters as much as knowing the numbers. If your plan makes you anxious, you will struggle to stay the course. The best plan is one you can hold through storms without panic. Balance also connects to your time horizon. If you have decades, you can allow more growth risk because you have time to recover. If you need money soon, you hold more safety. Matching your horizon to your balance prevents mistakes. It aligns your plan with your real life. It lets you use time as a shield for growth and caution as a shield for near needs. Many investors think of risk as something to fear, but risk is simply part of the process. Without risk, growth would not exist. Markets reward those who accept short-term risk for long-term reward. Balance does not erase risk, it makes risk manageable. It turns risk from a threat into a tool. By setting the right balance, you allow yourself to stay invested long enough to benefit from growth. Chapter 8 teaches that balance is not about perfection. It is about steadiness. It is about finding a mix that lets you breathe, a mix that gives you confidence to stay the course. You do not need the highest return. You need a return that meets your goals and lets you rest at night. Balance is what transforms investing from a gamble into a plan. As you sit with these thoughts, know that balance is only one part of peace. Even with baskets set and risks spread, money will still bring choices. You will face the decision of how much to save, how much to spend, and how much to keep safe. These choices shape your daily life as much as your future. In Chapter 9, we will explore how saving and investing work together, and how building both can give you a sense of safety today while preparing you for tomorrow.
You now know that risk and reward walk together and that balance keeps you steady. But balance is not only about stocks and bonds. Balance is also about saving and investing. Saving gives you safety today. Investing builds your future tomorrow. When you hold both, you feel secure in the present while also preparing for what comes next. Saving is money you keep close. It is money for rent, food, and bills. It is also money for emergencies. An emergency fund is your shield against surprise. Life always brings surprise. A flat tire, a medical bill, a sudden job loss. If you do not have savings, you may be forced to sell investments at the worst time. You may also fall into debt. Savings protect you from this trap. They give you space to breathe. Investing is money you set aside for growth. It is money you do not need right away. It may be for retirement, a home, or education. Investing carries risk in the short term, but it rewards you in the long term. This is the money that builds your future. When you invest, you trust time to grow your wealth. When you save, you give yourself calm in the moment. Both are necessary. Some people focus only on saving. They keep all their money in cash. This feels safe. But over time, inflation eats away at it. Prices rise, and the money does not grow. After years, the savings buy less than before. Others focus only on investing. They put all their money into the market. This grows over time, but it leaves them exposed to emergencies. One surprise can force them to sell at a loss. Both extremes bring stress. Balance between saving and investing brings peace. Experts often suggest 3 to 6 months of living expenses in an emergency fund. This amount gives you a cushion against most surprises. It does not need to grow like investments. It only needs to be safe and ready. A high-yield savings account is often the best place. It pays some interest and keeps your money accessible. Once your emergency fund is set, you can focus on investing the rest. Think of saving and investing as 2 streams flowing into one lake. One stream is steady and close. It feeds your daily life and protects you from drought. The other stream runs longer and deeper. It fills the lake over years, creating abundance. You need both streams. Without savings, the lake runs dry when a hot day comes. Without investing, the lake never grows beyond the basics. Together, they keep the lake healthy and full. The choice between saving and investing often depends on your stage of life. When you are first starting, building savings should come first. It protects you from setbacks. Once savings are secure, investing takes the lead. It builds the growth you need for long-term goals. As you get older, you may shift back towards saving more. Each stage asks for a different mix, but the principle remains the same. Both are important. It is also important to separate your savings from your investing. If the money is mixed together, it is easy to use investments for emergencies. Keep them in different accounts. Label them clearly. This way, you protect your investments from short-term needs. You also protect your savings from the temptation to chase higher returns. Clarity prevents mistakes. Chapter 9 also reminds us of the emotional side. Saving gives comfort because it is visible and stable. You can see the number in your account and know it will not change overnight. Investing tests your patience because it moves up and down. At times, it feels slow. At times, it feels scary. But over years, it rewards you with growth that savings cannot match. You need both the comfort of safety and the challenge of growth. One calms you today. The other builds tomorrow. Many people feel guilty when they cannot save much. They think their small amounts do not matter. This is not true. Even small savings build confidence. They remind you that you are capable of protecting yourself. The same is true for investing. Even small contributions grow over time. The point is not the size of each step. The point is that you are moving forward. If you are in debt, the balance shifts again. High interest debt often grows faster than investments. In this case, focusing on paying off debts is like saving. It protects your future by stopping the drain. Once debt is managed, you can return to the balance of saving and investing. The principle remains the same. Protect yourself now and grow for later! Chapter 9 teaches that saving and investing are not rivals. They are partners. One protects your present. The other builds your future. Together they create stability. Together they create hope. Without one, the other feels fragile. With both, you feel steady and strong. This is how you build financial peace. And yet, even with savings and investments said, the journey is not over. There is still the question of habit. How do you stay consistent year after year? How do you keep going when life is busy? When emotions rise, or when progress feels slow? In Chapter 10, we will explore the power of steady rituals and how building small habits can turn money management into a quiet act of self-care.
You now understand that both play a role. Saving protects you today, and investing builds your tomorrow. But knowing this is not enough. The real challenge is doing it again and again, year after year. Consistency is the bridge between knowing and living. Without consistency, even the best plan falls apart. With it, even small steps grow into lasting change. Habits are what carry you through. A habit is not one big act, but a small, repeated act. You brush your teeth without thinking, you tie your shoes without effort. These habits protect your health and keep your day steady. Money works the same way. Building financial habits turns effort into routine. Routine turns routine into results. The strength is not in the size of each step. It is in the fact that the step is taken again and again. One powerful habit is automatic investing. When money moves from your paycheck to your investment account on its own, you remove the need for choice. You do not debate whether to invest this month. You do not wait for the right moment. It happens on schedule. This protects you from hesitation. It also protects you from spending the money before you invest it. Automation makes consistency simple. Another habit is setting a regular time to review your plan. This does not mean checking your account every day. That feeds fear and impatience. A calm rhythm is better. Once every few months is enough. In that review, you check if your contributions are flowing, if your allocation is balanced, and if your goals remain the same. This rhythm makes you feel in control without making you anxious. It keeps your compass aligned. Tracking progress is also a helpful habit. Some people use journals, others use simple spreadsheets. You do not need complex charts. Even a note that shows how much you saved or invested each month is enough. Seeing progress builds motivation. It reminds you that your effort matters. It gives you proof that small steps add up. This proof helps you stay steady when progress feels slow. Habits also protect you during storms. When the market drops, emotions rise. But if your contributions are automatic, they continue. You keep buying at lower prices. This is dollar cost averaging in action. It feels hard in the moment, but it pays off when recovery comes. Habit protects you from fear. It keeps you moving even when the road feels rough. Some habits are about mindset, not money. Gratitude is one. Take time to notice the security your savings bring. Take time to value the progress your investments have made. Gratitude shifts your focus from what is missing to what is present. This softens envy and eases shame. It makes patience easier. Another mindset habit is reflection. Ask yourself if your spending matches your values. If it does, peace follows. If it does not, you can adjust. Reflection builds alignment between your money and your life. Habits also help when life changes. If you lose a job, the habit of saving means you have an emergency fund. If you get a raise, the habit of investing means you put some of it toward your future. If you face a storm, the habit of reviewing means you know where you stand. Habits do not stop change, but they prepare you for it. They make you resilient. Chapter 10 reminds you that consistency does not require perfection. You do not need to invest every month without fail. Life will interrupt sometimes. What matters is returning to the habit as soon as you can. Missing one step does not erase the path. Returning keeps the path alive. Self-compassion is part of the process. Forgiving yourself for breaks makes it easier to begin again. Think about the way habits compound. One habit leads to another. Saving leads to investing. Investing leads to reviewing. Reviewing leads to gratitude. Gratitude leads to patience. Each habit supports the next. Over time, they weave together into a system that carries you forward with less effort. This is why building habits is more important than chasing perfect results. Consistency also builds trust in yourself. Many people doubt their ability with money. They think they will always fail. Habits prove otherwise. Each time you follow through, you tell yourself a new story. You show yourself that you are capable. This trust grows with each repeated act. It becomes part of your identity. You begin to see yourself not as someone who struggles with money, but as someone who cares for money with calm. Chapter 10 shows that habits turn knowledge into life. They protect you from storms, they ease your emotions, and they build your future step by step. They make your plan more than words on paper. They make it part of your daily rhythm. When habits take root, your financial life grows quietly in the background while you live your days in peace. And yet, even with habits, another test comes. You may feel envy when others show off, or you may feel doubt when your balance lags. You may see people chasing fast wins and feel tempted to follow. These emotional traps return in many forms. To stay steady, you must learn how to see them clearly and release their pull. In Chapter 11, we will explore these emotional traps in detail and see how to keep your peace. When comparison calls you away from your path, you now know that steady rituals protect your path. Automation, gratitude, and regular reviews give you strength. They make progress possible even when storms arrive. But there is still another challenge, one that habits alone cannot solve. This challenge lives in your emotions. It is the quiet voice of comparison, the sharp pull of envy, and the heavy weight of shame. These emotional traps can undo years of patient effort. If you are not careful, one of the most common traps is comparison. You see someone online boasting about huge gains. You hear a friend talk about a quick win on a risky stock. In that moment, your own plan feels small. You begin to question why you are moving so slowly. You wonder if you should copy them. Comparison is powerful because it makes you forget your own goals. It makes you believe you are behind even when you are on track. Envy grows from comparison. It whispers that others are smarter or luckier than you. It tells you that your steady path is boring. Envy makes you want what others have, even if it does not fit your life. The danger is that envy can push you to abandon your balanced plan. It can tempt you into risks that are not yours to take. Many investors lose money not because of the market itself, but because envy led them off their path. Shame is another trap. When markets fall and your account drops, shame tells you it is your fault. Shame says you should have known better, or that you are not capable of managing money. This heavy feeling makes you want to avoid your accounts. It can even make you stop investing altogether. Shame is dangerous because it turns a normal market event into a personal wound. But market drops are not personal. They happen to everyone. They are part of the process. Another emotional trap is herd behavior. When many people rush to buy something, you feel pressure to join. When many people sell, you feel pressure to sell too. Herd behavior feels safe in the moment because you are moving with the crowd, but following the crowd often means buying high and selling low. It is the opposite of what builds wealth. The crowd is moved by fear and greed. If you follow without thinking, you are pulled into their mistakes. How do you escape these traps? The first step is awareness. When you notice comparison rising, pause. Remind yourself that the stories you see are incomplete. People share their wins and hide their losses. What looks like success may not be the full truth. When you notice envy, return to your own goals. Ask yourself if the choice fits your plan. If it does not, let it go. When shame appears, remind yourself that losses are normal. Everyone experiences them. They are not proof of failure. They are proof you are investing. One tool that helps is writing down your reasons for investing. When envy or shame grow strong, read your reasons again. They ground you. They remind you that you are building peace for yourself, not competing with others. Another tool is limiting how much attention you give to noisy voices. The less time you spend on headlines or posts that trigger envy, the less power they hold. Protecting your attention protects your emotions. It also helps to practice self-compassion. Speak to yourself the way you would to a friend. If your friend lost money in a market dip, you would not tell them they were foolish. You would remind them that this is part of investing. You would tell them to stay calm. Offer yourself the same kindness. Self-compassion breaks the hold of shame. It reminds you that you are learning and growing. Habits from Chapter 10 also guard against emotional traps. Automatic investing keeps you moving when envy tempts you to chase. Regular reviews remind you of your long-term path when shame makes you want to quit. Gratitude softens envy by focusing your attention on what you already have. Habits and awareness together create resilience. Remember too that emotions are not enemies, they are signals. Envy shows you that you care about progress. Shame shows you that you value responsibility. Fear shows you that safety matters to you. The key is not to obey every signal, but to listen and learn from them. When you pause and reflect, emotions guide you instead of control you. Chapter 11 shows that the market is not only about numbers, it is also about feelings. Comparison, envy, shame, and herd behavior are part of every investor's journey. You cannot erase them, but you can understand them. With awareness and compassion, you keep them from steering your decisions. You return to your plan, your balance, and your habits. You stay the course. And yet, even as you learn to manage emotions, another question comes: how do you adjust your plan when life itself changes? Markets are not the only source of shifts. Families grow, jobs change, health needs rise. These changes affect your goals and your path. In Chapter 12, we will explore how to review and adjust your plan with care so that it stays aligned with the life you are living. You now understand that comparison and shame can trap you. You know that envy and herd behavior can pull you away from your path. You also know that awareness and compassion help you return to calm. But even with steady habits and emotional strength, your life itself will change. Families grow, jobs shift, and needs appear. When life changes, your plan must change too. Adjusting your plan is not a sign of failure, it is a sign of care. The first reason to review your plan is that your goals may shift. At one stage, you may focus on building wealth for retirement. At another stage, you may want to save for a child's education. Later in life, your goal may be to preserve what you have rather than to grow quickly. A plan that once fit you may no longer serve your needs. Reviewing your goals keeps your plan aligned with your life. Another reason is that your risk tolerance may change. When you are younger, you may feel comfortable with larger swings in your account. As you age, the same swings may cause stress. Shifting towards safer assets as you grow older is a normal and wise step. It does not mean you are weaker. It means you are matching your plan to your stage of life. This keeps you invested without fear. Rebalancing is also part of adjusting. Over time, markets shift your balance between stocks and bonds. If stocks rise faster, they may take up more space in your portfolio than you intended. Rebalancing means trimming them back and adding to bonds to restore your chosen mix. This discipline prevents your portfolio from drifting into more risk than you want. It keeps your compass steady. Life events can also force changes. A new job may bring a retirement plan with different choices. A health issue may require more savings in cash. A move to a new city may increase or decrease your expenses. These shifts are not mistakes. They are part of living. Reviewing your plan after major life events ensures that your money continues to serve you well. It is helpful to set a rhythm for review. Once a year is enough for most people. In that review, you check your goals, your allocation, your contributions, and your savings. You ask if your plan still matches your life. If it does, you continue. If it does not, you adjust. This rhythm keeps you from making changes out of fear, while still giving you space to adapt when needed. One trap to avoid is over-adjusting. Some people change their plan too often. They respond to every headline or every small shift in their life. This constant change creates confusion. It also reduces growth. Adjustments should be thoughtful and tied to real needs, not to noise. Calm and steady reviews prevent this trap. Another trap is avoiding review out of fear. Some people do not want to face their accounts. They fear seeing mistakes. But ignoring your plan only makes the problems grow. Facing your plan with compassion allows you to make small changes before they become big problems. It also reminds you of the progress you have made. Reviews are not punishments, they are acts of care. Adjusting your plan also strengthens your trust in yourself. When you face change with calm, you prove to yourself that you are capable. You show yourself that money is not a rigid burden, but a flexible tool. This trust makes future changes less scary. It builds confidence that you can handle what life brings. Another benefit is that reviews remind you of your purpose. Reading your goals each year renews your energy. It brings focus back to what matters most to you. This focus softens envy and quiets shame. It shifts your mind from comparison to alignment. You measure yourself by your own path, not by the noise of others. Chapter 12 teaches that plans are living. They grow and shift with you. They are not carved in stone. Adjusting them is not failure. It is wisdom. It is how you keep your compass pointing toward your true north. It is how you make sure your money serves your life, not the other way around. And yet, even with reviews and adjustments, another question remains. Money is not only about numbers, it is also about connection. It is about community and the stories we share. In Chapter 13, we will see how building community around money can ease fear, bring support, and remind you that you are never walking this path alone. You now understand that your plan must live and breathe with you. You know that changes in life are natural and that your money must shift with them. But money does not exist in silence. It is not only about private accounts and personal choices. Money is also about connection. It shapes relationships, communities, and the stories we tell one another. The journey becomes lighter when you walk it with others. For many people, money feels like a secret. Families do not speak about it. Friends avoid the topic. Silence makes fear grow stronger. When you feel alone, every mistake feels larger. Every doubt feels heavier. Breaking this silence begins with small steps. It may mean talking with a partner about shared goals. It may mean asking a trusted friend how they approach saving. It may mean joining a group where people share their money journeys. Connection reduces shame. It turns silence into support. Community can take many forms. Some find it in family. Parents who teach children simple lessons about saving and investing create a legacy of strength. Children who grow up with open conversations about money often carry less fear into adulthood. Others find community among peers. Talking about budgeting, debt, or investing with friends creates accountability. It reminds you that struggles are normal. There are also larger communities built for financial support. Online forums, local investment clubs, and workplace groups give people a place to share knowledge. In these spaces, you can ask questions without judgment. You can learn from the mistakes and successes of others. You can see that people from all walks of life face similar challenges. The comfort of community is knowing that you are not walking alone. Sharing your story also helps others. When you talk about your own money journey, you give others permission to be honest about theirs. You may inspire someone to start saving. You may comfort someone who feels behind. You may learn that others see your progress as meaningful, even when you do not. Community creates a circle of growth. Each person adds strength to the others. Accountability is another gift of community. It is easy to drift when no one knows your plan. When you share your goals with others, you add gentle pressure to follow through. This does not mean strict judgment. It means encouragement. A friend may remind you of your goal when you feel tempted to give up. A group may celebrate your progress when you hit a milestone. Accountability turns private effort into shared triumph. Another benefit is learning from diverse experiences. Your own view of money is shaped by your background. Others may see things differently. Hearing their stories broadens your perspective. It may show you options you had not considered. It may also confirm that your struggles are common. This learning builds wisdom and compassion. It teaches you to see money not only as numbers, but as human experience. Community also protects against emotional traps. When you see others face storms and recover, your own fear softens. When you hear others admit to envy or shame, you feel less isolated. When you share your emotions openly, you release their hold on you. Connection turns private feelings into shared humanity. This makes it easier to stay steady when the market moves. Chapter 13 teaches that money is not a solitary path. Building community brings strength, wisdom, and comfort. It shows you that your journey is part of a larger story. It reminds you that support is available if you reach for it. Silence creates fear, but connection creates peace. By walking together, you find courage to continue. And yet, even with community, there are moments when you are alone with your thoughts. At night, when the world is quiet, doubt may return. This is why reflection matters. In Chapter 14, we will explore how to pause, look back, and notice the progress you have made. Reflection brings meaning to the journey and prepares you for the steps ahead. You now know that sharing your story brings relief. You understand that silence adds weight and that connection lightens the load. But even when others stand with you, there are moments when you must turn inward. Reflection is what gives meaning to your journey. Without reflection, progress can feel invisible. With it, every step becomes part of a larger picture. Reflection is not about judging yourself. It is not about numbers on a screen. It is about noticing the path you have walked. Maybe you remember the first time you opened an account. Maybe you remember the fear of seeing your balance fall. Maybe you remember the pride of your first consistent deposit. Reflection gathers these pieces together. It shows you how far you have come. When you pause to reflect, you slow the rush of daily noise. Markets move fast. Headlines change every hour. Without reflection, you are swept along. Reflection pulls you out of the current. It lets you see the long arc of your effort. You notice that storms passed, that patience held, and that habits grew. This awareness brings calm. It tells you that your work has meaning. One way to reflect is through writing. Keep a simple journal. Write about what you saved, what you invested, and how you felt. Over time, these notes tell a story. They remind you of your early fears and how you overcame them. They remind you of your small wins and how they added up. When doubt appears, reading your own words is proof that you are stronger than you thought. Another way is through regular check-ins. Once a year, sit quietly and review your plan. Ask yourself what changed in your life. Ask if your goals still fit. Ask what you are grateful for in your journey. This practice turns reflection into a ritual. A yearly ritual gives structure to your growth. It honors your effort. It keeps your compass aligned. Gratitude is a powerful part of reflection. When you reflect with gratitude, you shift your focus from what is missing to what is present. You notice the safety your savings provide. You notice the growth your investments created. You notice the wisdom you gained from storms. Gratitude softens regret. It reminds you that every step forward matters. Even the smallest progress is worth honoring. Reflection also heals shame. Shame thrives in silence. Reflection brings it into light. When you write or speak about mistakes, you see them as lessons. You see that they did not end your journey. They became part of your strength. Reflection reframes shame as growth. It tells you that mistakes are not proof of failure, but signs of learning. Another benefit of reflection is clarity. When you reflect, you see patterns. You notice what habits worked and which ones slipped. You notice what decisions brought peace and which brought stress. Clarity helps you make better choices in the future. It turns past experience into guidance. Without reflection, mistakes repeat. With reflection, mistakes transform into wisdom. Reflection is also about celebrating too often. We wait for huge wins before we celebrate. Reflection reminds us to honor small victories. The first $100 saved, the first month of automatic investing, the first time you stayed calm in a storm. These moments deserve recognition. Celebration builds motivation. It tells your mind that progress is real and worth continuing. Some people fear reflection because they think it will reveal how little they have done. But reflection often shows the opposite. It reveals strength you forgot. It shows effort you overlooked. Even if your balance is small, reflection shows that you are moving forward. The act of caring for your money is itself progress. Reflection reminds you that your journey is alive. Chapter 14 teaches that reflection is not a luxury. It is a necessity. It gives meaning to your effort. It heals old wounds. It renews your energy. Without reflection, you risk losing sight of your growth. With it, you see that you are capable and that your story has value. Reflection is what allows you to rest with peace instead of racing with fear. And yet, reflection is not the final step. After looking back, you must also look ahead. What dream do you now feel brave enough to pursue? What goal feels possible because you built patience, balance, and habits? In Chapter 15, we will see how dreams once hidden in fear can now rise into light, and how money becomes a quiet partner in building the life you choose. You have looked back at the path you walked. You have seen how patience, balance, and small habits shaped your growth. You have noticed your mistakes and turned them into lessons. You have honored your small wins and allowed them to give you strength. Reflection gave you meaning. Now it is time to look forward. Now it is time to ask what dream feels possible because of all you have learned. Dreams often hide behind fear. When money feels unstable, dreams feel out of reach. You tell yourself you will think about them later. You push them aside in the name of survival. But when you build habits, when you save and invest, when you balance and adjust, the fear begins to soften. Dreams that once felt impossible begin to feel within reach. This is the quiet gift of financial peace. It does not only protect you, it frees you to imagine again. Some people dream of retiring early with freedom to choose how they spend their days. Others dream of starting a business, writing a book, or traveling to new places. Some dream of supporting their family or giving back to their community. No dream is too small or too large. What matters is that the dream comes from your heart. Money becomes the partner that makes it possible, not the barrier that holds it back. The power of your journey is that money shifts from a source of stress to a tool for choice. You no longer see it as a weight pressing you down. You begin to see it as a resource that gives you space. This shift changes everything. It changes how you wake in the morning. It changes how you plan your days. It changes how you rest at night. Dreams need space to grow, and money management creates that space. To bring a dream to life, you begin with clarity. Write it down. Be honest with yourself. It may feel bold, but naming it gives it form. Once it is clear, you can shape your plan around it. Your investments, your savings, your habits all serve a purpose. They are no longer random acts. They become aligned with your vision. Alignment is what makes the dream real. Dreams also need patience. They rarely arrive overnight. They grow slowly, just like your investments. A small step today may not look like much, but it adds to tomorrow. The key is to keep moving. Each deposit, each choice, each reflection builds momentum. Over time, the dream that felt distant begins to feel close. Patience turns vision into reality. Another step is to allow flexibility. Dreams can change. What matters most to you today may not be the same in 10 years. That is natural. Your money plan must be flexible enough to follow your evolving vision. This is not a failure, it is growth. You are allowed to change your mind. You are allowed to let one dream fade and another rise. The strength is in giving yourself permission to choose again. Community also plays a role here. Sharing your dream with trusted people brings support. They can remind you why it matters when you feel tired. They can celebrate your progress when you doubt yourself. They can offer wisdom when your path feels unclear. A dream carried in silence is heavy. A dream carried in community is lighter and stronger. Dreams also give you motivation during storms. When the market falls and fear grows, remembering your dream reminds you why you stay invested. It turns abstract numbers into something real. You are not holding for the sake of holding. You are holding for the life you want. This connection makes patience easier. It gives storms less power. Chapter 15 shows that dreams are the final piece of the journey. Saving, investing, balancing, and reflecting all build toward this. They are not ends in themselves. They are means to create the life you choose. Your dream gives direction to your plan. It gives meaning to your habits. It gives light to your reflection. It gives hope to your patience. And yet the journey does not end here. You have walked through fog, storms, habits, emotions, and reflection. You have built strength and clarity. Now you stand at the edge of the story, looking toward tomorrow. What remains is a gentle close, a chance to gather everything together, to breathe and to rest. In the conclusion, we will return to the quiet truths, the early fears, and the steady hope. We will tie them into a final reminder that your story with money is still unfolding and that you are allowed to write it softly, one choice at a time. The conclusion begins where dreams left us. You have walked through every chapter, from the fog of confusion to the storms of fear, from the quiet patience of compounding to the freedom of naming your dream. Along the way, you have seen that money is not only numbers, it is feelings, choices, and time. It is patience and balance. It is community and reflection. It is the tool that gives you space to choose the life you want. You began this journey with fear. The word stock market once sounded heavy and sharp. It brought images of loss and risk. Now you see it differently. You see that a stock is simply a piece of a company. You see that markets rise and fall, but move upward over time. You see that storms are normal, and that patience turns storms into stories. You see that diversification protects you, and that habits carry you forward. You have also seen that money touches your emotions. It stirs envy, shame, and regret. It makes you compare yourself to others. But you learned that these feelings are not proof of failure. They are signals. They can guide you when you notice them with kindness. You are not broken for feeling fear. You are human. By building awareness and compassion, you turn emotions into teachers instead of traps. You now know that money works best when paired with saving for today and investing for tomorrow. You know that both are necessary for peace. You know that community matters, that sharing stories lightens the load. You know that reflection gives meaning, that gratitude turns small steps into victories. You know that dreams give direction, that they are the reason behind all the effort. The lesson that ties all of this together is that your financial journey does not need to be perfect. It needs to be steady. Progress, not perfection, is what builds peace. Each step forward matters, no matter how small. Each deposit, each choice, each reflection adds to your future. Your story is not written in one day. It is written in many days, in many quiet acts, in many decisions to continue. So tonight, allow yourself to rest. You have faced fear, but you have also built hope. You have seen that money does not have to control you. It can serve you, it can protect you, it can give you freedom to choose. You are not behind, you are not late. You are exactly where you need to be to begin again, one step at a time. As you close your eyes, remember the truth that is carried through every chapter. Markets grow over time. Patience matters more than prediction. Habits shape your path. Community lifts your heart. Reflection gives meaning. Dreams bring light. These truths are yours to hold. They are simple, they are steady, they are enough. Tonight, maybe you can forgive yourself for what you did not know. Maybe you can release the shame that was never yours to carry. Maybe you can rest in the knowledge that progress is already happening. You are learning, you are growing, you are capable. And tomorrow, when you wake, you will remember this. Your story with money is still unfolding. And you, dear listener, are allowed to write it softly, with patience, with care, and with hope.